what's happening in Canada is that mortgage growth continues to be so strong. Mortgages are a huge portion of the Canadian books, the Canadian banks. And because mortgages have that lower yield and spread, it's impacting more the Canadian side of the business and elsewhere. But with rate hikes coming, the first one for the Bank of Canada, the U.S. will probably raise in a couple of weeks. That's going to be a significant tailwind for the Canadian banks, P&C operations.
Hi, it's ggoernert, Senior Investment Advisor at Canaccord, Genuity Wealth Management and ggoernert Wealth Management. And welcome to the channel where we help you make sense of your financial world. Now, once again, if you like our content, have any ideas for future topics you want us to cover, please drop a comment, like, share, subscribe, all that good stuff. But today, I'm going to be joined by Canaccord Genuity financial analyst, Scott Jan. Scott, how are you?
I'm doing great, Greg. Thanks a lot. How are you doing?
I'm doing really well. Yeah, it's weather's nice out here, which is nice to see. What's it like in Toronto, your way?
Yeah, like if you look behind me, you'll see
I know.
nice downtown. It's bright, it's sunny, and it's getting warmer for the March break. So I think everyone's excited.
Exactly. And you're back in the office, which is awesome.
Yeah, 100% back, all of us. Starting last week. Great.
Awesome. Hey, Q1 for 2022 for the banks just came in. So earnings per share, we had a lot of beats on expectations. Why don't you talk about that?
Yeah, as you talked about the beats and the earnings, the group earnings were up 17% year over year. So Greg, well ahead of street expectations. All the banks beat on the headline basis. And if you kind of even exclude the credit benefit that we've seen over the past several quarters, it was still a massive, massive beat. So very high quality, mostly driven by revenue. So capital markets was really solid. We saw a resurgence in the loan momentum, up 4% quarter over quarter. And margins were a bit stable. But if you looked outside of Canada, margins were pretty decent. What's happening in Canada is that mortgage growth continues to be so strong. Mortgages are a huge portion of the Canadian books, the Canadian banks. And because mortgages have that lower yield and spread, it's impacting more the Canadian side of the business and elsewhere. But with rate hikes coming, the first one for the Bank of Canada, the U.S. will probably raise in a couple of weeks. That's going to be a significant tailwind for the Canadian banks, P&C operations, just in terms of the margin expectations that we saw. So margins were okay in the quarter, but it's going to get better on that front. So all in all, it was a really, really solid quarter from the banks, in terms of quality, credit, and what we're seeing is an emergence on that P&C side where it's been pretty dormant or stagnant.
Yeah, and why don't we just touch upon this, because I get a lot of questions about inflation and rising interest rates, and knee-jerk reaction for a lot of investors is that interest rates rising interest rates are a bad thing for the banks, and nothing is further from the truth, because banks make their money off the spread, so higher interest rates tend to be good for banks. Can you expand on that just a little bit and just fill in some of the blanks?
Yeah, you're right. So, we've been in a low rate environment for a long time. We've been at trough levels. A rising rate environment is materially better for the banks and their margin. We actually put out a report, Greg, out before the banks reported in terms of the interest rate sensitivities on each bank. So assuming 100 beep interest rate increase, albeit at a parallel curve, and that really never happens, TD would have 10% earnings accretion on 100 beeps. So that would be kind of like 4 rate hikes from here, or an incremental 3 that we've seen on the Canadian side. Yeah. And, CIBC and BMO was screened pretty high at 5-6% too. So 5-6% average earnings growth just on that rate hike environment is pretty substantial because it is including all the other businesses that the banks have. So definitely a positive. The one negative that higher inflation would breed would just be on the cost side. Half the banks increased their fiscal 2022 cost guidance with fiscal Q1 results, but half of them kept it similar to fiscal Q4. The banks that did hike their cost guidance, it wasn't that material at all. For example, BMO was 1 to 1.5% because of inflationary pressures. But if that persists for the duration of the year, I suspect that could go a lot higher. But the net result of higher rates for banks is a positive.
Yeah. Now, the other concern that I get from clients on a regular basis is bank exposure to Canadian mortgages and the housing valuations. What are your thoughts there? Because as we just noted before, banks make a lot of the money off of the housing sector and the mortgage sector. What are your thoughts on bank exposure to Canadian mortgages?
Yeah, so the mortgage exposure from the Canadian banks have increased a little bit because the growth has been incrementally better, and we saw it in fiscal Q1, Greg. Group bank mortgage growth was up an outstanding 13% year over year. So
Wow.
that's historical average, and well above what people were expecting in the quarter. And kind of our channel checks heading into the start of fiscal Q2 is that it's going to be robust still as people are locking in rates to buy a house in anticipation of all these rate hikes we're going to see this
Mhm.
year. So mortgage growth is going to continue near term and probably slow down the back half of the year and into fiscal 2023, but still be productive growth. On the margin side, and why margins haven't been expanding is because mortgages have been disproportionately growing faster than commercial and other personal portfolios. And mortgages, you mentioned, have lower yields, but better risk-adjusted profit because there's less capital needed to be put up for mortgages. So it's a good business for the banks, and they usually use it as an anchor product to cross-sell other products or to get clients in the door. So they're not too suffice to the fact that, yeah, they're not going to make that big profit, but there's a lot of ancillary revenues associated with that, like cross-selling other products that the banks, look to capitalize on.
Yeah, well, that's a good overview. Now, the other thing that we just talked about briefly before we started the show here, the Digital Disruptor Conference. You were there on the financial technology side. Can you just give a bird's eye view of what you're seeing there, and maybe explain to some people who aren't aware of that sector what it entails?
Yeah, so we held an event a couple days ago, Greg, as you alluded to, Digital Disruptor Conference. I was involved in more of a moderated role because of my financial coverage, but my panel was on U.S. fintech or online companies. We also had one on DeFi and cryptocurrencies. So these are all emerging disruptive technologies that have probably accelerated during the pandemic in terms of usage as everyone has been at home. And going forward, I think it's going to continue to be a very important theme, and disruptor to the industries that we follow. Another reason is that we did the conference is a lot of these stocks have actually come off a lot lately, as you
Hmm.
know. These fintech companies that are more sales driven and not bottom line driven at this point. So I think there's a real opportunity with a lot of the companies that we showcased, and they have good business models. They could be more scalable. Revenue growth is there, and we just wanted to put it on people's watch list to follow because it's not really known too much to the environment. In terms of what these companies are capable of. They're all very, very small micro cap companies that we had there.
Mm. What are you seeing on consumer adoption on the digital space?
Yeah, it's clearly accelerated from the bank level down to the fintech level as well. I mean, the banks highlight that every quarter, that mobile bank usage and digital capabilities continue to increase. And I think that's the reason why a lot of banks are closing branches or making them more interfaced, more advice than typically before. So one of the things coming out of the pandemic is I think you'll see digital continue to be an important theme, and the banks continue to rationalize their branch network as investors gravitate towards that source of business.
Yeah. Now, when we talk about financial technology, a lot of times the big elephant in the room is what the regulatory environment's going to look like, and is that going to hurt or help the adoption and growth of the sector? What are your thoughts?
I think it's going to help. I think the regulatory environment wants to encourage innovation. Especially in Canada, where you have a lot of oligopolies, right? A lot of the
Hmm.
sectors that to banks, life cos, telcos, utilities. So I think the regulatory environment does encourage innovation, and I think regulatory bodies and these big financial institutions definitely help support and cater growth in terms of partnerships or purchases of these smaller companies. I think it's very important as we change, as the world changes so quickly, that we support these small companies, even at the government level.
Yeah, that makes sense. Now, just before we wrap up, why don't we just quickly touch upon the insurance sector from your point of view? What are the life cos looking at right now?
Yeah, the life goes looks pretty good. I mean, the Q4 results were more mixed, Greg.
Mhm.
And I think the rate environment and the yield curve has been more of a disruption lately for the life goes. We've seen rates decrease, and we've also seen the yield curve flatten, or more importantly, the long end come down a little bit, which is a lot more important for the life co sector, as they do a lot of their business or their insurance policies well out in events, so high duration. That said, the sector pays above average dividend yields. They have significant excess capital. They're buying back stock. They're raising their dividends. They're conscious on cost. And from a sales standpoint, the insurance sales have been very, very strong through the pandemic. Perhaps select regions in Asia have been a bit slow, but that's going to come back. And in terms of the wealth management aspect of the life insurance arms, like the sales have been really, really solid. So there's a lot to like about the sector. I just think the recent rate environment and where the curve is right now, makes them maybe less enthusiastic on the near term. But we're so positive on the subsector medium term.
Hey, well, great wrap up. Thanks once again, Scott Chan, Canaccord Genuity Financial Analyst. Bye, Scott.
Bye.
Thanks for watching. If you want to see more content like that, please consider subscribing or join me on my website, ggoernert.com. That's ggoernert.com. Look forward to seeing you there.